So if you're trying to save for retirement and are looking for the best way to guarantee that you'll have enough money to last you those 20 or 30 years or more while you're retired without, of course, running out of money, then you're probably going to want to watch this video, because in this video, I'm going to show you how you can improve your retirement outcomes by getting higher pre-tax returns with lower risk, all while reducing your tax liabilities and allowing your retirement portfolio to grow to almost 5 times more than it otherwise would have. Hi, my name is Rajiv Rebello from Guaranteed Annuity Experts, and today I'm going to show you exactly why Guaranteed Lifetime Income Annuities, or GLI annuities as we'll be referring to them in this video, are such great retirement planning tools. And more importantly, how you can use them to increase your chance of having a successful retirement. And we're going to demonstrate all of this today by going over a case study in which a couple nearing retirement increased their chance of meeting their retirement income goals from 56% without a GLI annuity to 74% with a GLI annuity, all while increasing their expected after-tax wealth at age 95 by nearly 5 times, from 1.5 million to 7.1 million. So let's go ahead and meet our couple for our case study. John and Sally are both aged 55 and live in California, which has a high state income tax. Their combined household income from their salaried W-2 income jobs is $500,000 a year. Their investment portfolio is at $3 million and is 60% allocated to stocks and 40% allocated to bonds, otherwise known as a 60-40 portfolio. So that means of their $3 million portfolio, $1.8 million is invested in stocks and $1.2 million is invested in bonds. John and Sally want to retire at age 65. And when they do, they want to draw $250,000 each year in their first year in retirement. And then they want to increase that amount by 2% every year to meet inflation. Well, what is their current chance of meeting this desired retirement income goal with their current 60-40 portfolio? We can do what's called a Monte Carlo simulation to help answer that. For those who might not be familiar with Monte Carlo simulations, all it is a math technique that financial planners use to help determine retirement outcome probabilities. If you want a more detailed explanation, I'm going to include a link in the description here that goes over it in full detail, along with this whole case study that we'll be covering here today. When we do this Monte Carlo simulation, we can see that John and Sally only have a 56% chance of meeting their retirement income goals. Now that's not too high, because that means that 44% of the time, this couple will run out of money in retirement and won't be able to meet their $250,000 a year spending goal. What does this mean? This means that they'll have to cut down their spending goals in retirement, and obviously that's not something that most people want to do. What if John and Sally took the money that they would have allocated to their bond portfolio and instead use that to buy a guaranteed lifetime income annuity? Would that help their retirement income goals? We can answer that by doing the same Monte Carlo simulation that we did earlier. So now let's assume John and Sally take the $1.2 million that they would have invested in a taxable bond fund and use that to buy a guaranteed lifetime income annuity. That guaranteed lifetime income annuity will pay $181,867 every year starting at age 65 for as long as either John or Sally are alive. Again, only one of them has to be alive for the annuity to keep paying out. So that means that on the original $1.2 million that John and Sally invested in the annuity, they are getting 15.2% of that amount every year starting at age 65 for as long as either of them are still alive. And they're doing this simply by replacing the bond part of their portfolio with a guaranteed lifetime income annuity. And when we do that, we can see that by replacing this taxable bond part of their portfolio with a guaranteed lifetime income annuity, that John and Sally actually increase their chance of meeting their retirement income goals, again, from 56% without an annuity to 74% with an annuity. The reason that clients have better retirement outcomes using the guaranteed lifetime income annuity is because the GLI annuity is helping these clients create more after-tax wealth in retirement. In fact, at age 95, John and Sally are expected to have at least 5 times more wealth by using the GLI annuity instead of a taxable bond portfolio. With a regular taxable bond portfolio, the Monte Carlo simulation shows that John and Sally would only have $1.5 million in after-tax wealth at age 95. However, with the GLI annuity, John and Sally can expect to have about 7.1 million in after-tax wealth at age 95. That's nearly 5 times as much wealth. John and Sally can use this extra wealth in their later years to spend it on themselves, home health care, or simply just to give it away to their children when they pass away. This is what makes GLI annuities such powerful retirement planning tools. It protects John and Sally from running out of money in retirement, since they'll always have a stream of income coming in regardless of what the market does. Of course, the GLI annuity increases the amount of after-tax wealth that they'll have. So John and Sally are getting both. They're getting a higher chance of meeting their retirement income needs and more after-tax wealth to pass on to their beneficiary. If you're interested in working with us, just reach out to us via the link in the description below or send us an email at hello@guaranteedannuityexperts.com, and we'll help you determine if a GLI annuity is the right fit for you, and more importantly, we'll be able to quantify how much better your retirement planning will be because of it.